Did you know that nearly 90% of dot-com companies failed during the crash of the early 2000s? With the internet booming, many thought every tech startup was a guaranteed goldmine. But was it really that simple? Let's dive into the rollercoaster ride of the dot-com era. Welcome back to the channel, everyone. Today, we're taking a trip down memory lane to explore one of the most fascinating chapters in internet history, the dot-com bubble. Picture this. The late 1990s, a time when the internet was just beginning to change the world. Investors were pouring money into tech startups at an astonishing rate, believing they could ride the wave of innovation all the way to success. But, as we know, this story has a plot twist that would leave many in financial ruins. So, let's set the stage for this explosive growth and the eventual collapse of countless companies that promised to revolutionize the way we live and work online. Now, let's talk about the challenges that these dot-com companies faced. First up, unsustainable business models. Many startups were throwing around buzzwords like disruptive and revolutionary, but they often lacked a solid plan for how to actually make money. It was all about growth, growth, growth. Investors were so enamored with the potential that they overlooked the basics of profitability. Then we have overvaluation. At the height of the dot-com boom, companies like Pets.com were being valued at billions, despite having little more than a cute mascot and a flashy website. The stock market was on fire, and every tech company wanted a piece of the action, leading to inflated stock prices that were simply not backed by revenue or real-world performance. Lastly, there was a complete lack of profitability. Many dot-coms were burning through cash faster than they could say, IPO. Their business plans often relied on the hope that they would figure out how to monetize their services later. Spoiler alert: most didn't. As the reality of these challenges set in, it became increasingly clear that the bubble was not sustainable. Let's rewind a bit and delve into the rise of dot-com companies in the late 1990s. This was a time when the internet was transforming from a niche interest into a household staple. Companies like Amazon, eBay, and Yahoo were emerging as giants, attracting massive investments and attention. Venture capitalists were eager to fund any startup with a com at the end of its name, leading to a frenzy that was hard to ignore. The investment trends were wild. Large sums of money were being funneled into internet ventures, many of which were operating without any clear path to profitability. It was like a gold rush. Everyone wanted to stake their claim in this new digital frontier. You had people quitting their jobs to start the next big tech company, convinced they could create the next Amazon or Google. And the hype? Oh boy, it was palpable. Media coverage surrounding these companies was at an all-time high, with countless stories of overnight millionaires and groundbreaking innovations. The stock market reflected this excitement, with tech stocks soaring through the roof. But, as we all know, what goes up must come down. And the higher the stocks climbed, the closer we got to the inevitable crash. Fast forward to the year 2000, and the dot-com bubble finally burst. What were the major factors that led to this market crash? For starters, the reality of those unsustainable business models hit hard. Investors began to realize that many of these companies were not going to turn a profit anytime soon, if at all. Stocks that had been flying high came crashing down, and panic set in. Companies that had once been celebrated were suddenly filing for bankruptcy left and right. Iconic names like Cosmo.com and Boo.com became cautionary tales of the dot-com era. The immediate aftermath was brutal for investors and employees alike. Millions were lost, and thousands of jobs disappeared overnight. The tech industry, once seen as a goldmine, was now viewed with skepticism. The consequences of the crash were far-reaching, leading to increased scrutiny of tech companies and a more cautious approach to investing in startups. It was a harsh reality check that echoed through Wall Street and Silicon Valley, forcing a re-evaluation of what it meant to succeed in the tech world. So, what have we learned from the dot-com bubble? First and foremost, it's crucial to have a sustainable business model that doesn't rely solely on hype or speculation. The importance of profitability cannot be overstated. Just because a company is innovative doesn't mean it's invincible. The lessons from this era remain relevant today, especially as we continue to see new tech startups emerge at a rapid pace. The dot-com era taught us that the internet could transform the world, but it also reminded us of the risks involved in overvaluation and unchecked growth. As we look at today's tech industry, it's essential to remember these lessons and approach new ventures with a healthy dose of skepticism and realism.